As we begin the course, let's define the term insurance. The most familiar definition is that insurance is a contract in which an insurance company or government agency provides a guarantee of compensation for specified loss, damage, illness, or death in return for payment of a premium from an insured or group of insureds. The more traditional definition of insurance is a method of handling pure risk by spreading it over a large number of similar individuals. Insurance is based on the law of large numbers, and you will see this phrase listed on your state licensing exam outlines. This law shows us that we can predict, fairly accurately, what will happen to a large group of similar individuals in a given time period. When large groups of similar individuals are combined, we call them risk pools. Insurance companies hire actuaries who make mathematical predictions about things like how many of the people in any given risk pool will have their home destroyed by a tornado, get cancer, or die in a given year. Insurance contracts are governed by the principle of indemnity. The principle of indemnity assumes that an insured, who has suffered a loss, should only be restored to the approximate financial condition that existed prior to the loss, no better and no worse. If an insured makes a profit from their loss, the principle of indemnity has been violated. Before a person can purchase insurance, they must have insurable interest in the death or injury of the insured person, or the damage or destruction of the property or object being insured. So that would mean that the person must have a lawful, substantial, economic interest in the life, health, property, or object being covered under the insurance contract. For example, a spouse would have an insurable interest in the life of the other spouse, because if they died, there would be a loss of income or other items such as childcare. Another example would be a person who has purchased a house. The homeowner would have an insurable interest if that house was damaged in a flood, because the repair of the home would become a financial burden. The bank holding the mortgage on this house would also have insurable interest. The term person, when referring to the purchaser of the insurance policy, includes an individual, company, insurer, association, organization, partnership, or any other legal entity. With property and casualty insurance, the person purchasing the policy must have insurable interest at the time of the loss. With life insurance, the person purchasing the policy must have insurable interest at the time the insurance policy is purchased. Risk is the possibility that a loss might occur, and risk is also the reason that people buy insurance. If a certain event happens, an accident, sickness, or death, a loss occurs. The loss can be of life, or the loss of a loved one in the event of death, or the loss of income due to accident or sickness. In the case of property and casualty insurance, a structure may burn or a commercial truck may be involved in an accident, and the insured is sued. It is important to remember that not all risks are insurable. Let's discuss the characteristics of an insurable risk. First, the loss must be definite and definable. This means that the loss must be concrete, conclusive and specific. The loss cannot be ambiguous. The loss must be accidental, meaning, the loss must be sudden and unforeseen. The insured cannot have caused the loss. The following characteristics create an insurable risk. The law of large numbers should apply, meaning the risk should be spread among a large number of similar individuals. The loss must be great enough as to cause economic hardship for the insured. The insurance must be offered at a reasonable premium cost to the insured. The loss must not be so catastrophic in nature that it imperils the solvency of the insurance company. All of these elements are not required to be present for every insured risk, but most of them should exist whenever possible. In the insurance business, we deal with two broad categories of risk. The first category is pure risks. A pure risk is encountered in a situation where there is only the possibility of a loss. There is never the possibility of making a profit. Some examples would be the medical expenses incurred due to an accident, a liability lawsuit brought against an insured, or damage to property by fire or lightning. This is the type of risk that responds well to the law of large numbers, and is the type of risk for which insurance companies write policies. The second broad category of risk is speculative risks. These risks are incurred in situations where either a profit or a loss is possible. Examples of speculative risks would be betting at a horse race, or investing in a volatile real estate market. Insurance companies do not write policies on risks where the possibility of financial gain exists. Remember, most risks are neither completely pure, nor completely speculative. The following types of risk may or may not be insurable. Static risks are historical factors that do not frequently fluctuate. They result from a static or unchanging environment. Static risk factors tend to be associated with long-term risk, such as an area that may only flood every 100 years, or a genetic illness that may or may not express itself. Static risks are pure risks because they may or may not occur, and are, therefore insurable. A dynamic risk is associated with change. For example, a new and fatal virus erupting into society, technological advances that may cause a business to lose market share, or a change in law regarding hazardous waste disposal, that now leaves a business liable for practices that were previously acceptable. Dynamic risks are not insurable. Fundamental risks affect entire groups of people or property within a society. For example, floods, earthquakes, terrorism, and economic collapse affect large numbers of people. However, these risks can be catastrophic in nature, and would cause an insurance company to become insolvent if it was to pay the claims on such catastrophic losses. This is the reason that these types of policies are heavily subsidized by the government, or offered solely through a government agency. The subsidy allows these types of fundamental risks to be insurable. There are other types of fundamental risks that are not insurable. An example would be double-digit inflation causing the cost of production to become too high, causing a business to file for bankruptcy. Particular risks affect only the individual person or family, and not the entire community or society. Particular risks arise when one situation occurs simultaneously with another specific event that increases the chance of a loss. For example, an insured is at particular risk when they happen to be at home when a burglar breaks in. A particular risk can be expressed with the saying, "I was at the wrong place, at the wrong time." Particular risks are usually insurable. On your state licensing exam, you are likely to encounter a question that asks about the difference between a peril and a hazard. A peril is the actual cause of a loss. For example, fire, windstorm, or hail may be the actual cause of damage to a house. A hazard is any condition that increases the possibility of a loss. Physical hazards are the material, structural, environmental, or operational features of an insured risk that may create or increase the opportunity for injury or damage. Defective building materials, exposure to toxic chemicals, or a slippery sidewalk are all physical hazards that increase the possibility of a loss. A moral hazard is a condition that increases the probability that a person will intentionally cause, create, or inflate a loss. A moral hazard is generally an act created out of intent, and can be calculated or even premeditated. For example, an insured who poisons his, or her spouse, to collect on a life insurance policy would certainly be a moral hazard. A moral hazard is a condition of inattention to, or disregard for, one's own life, health, property or behavior, that increases the frequency or severity of a loss. A moral hazard is attitudinal, and involves an apathetic disregard. Just remember that when morale is low, apathy is high. An example would be an insured who inherits a house in the country from a deceased relative. The insured lives in a city, and is very apathetic about owning the country house, leaving it vacant, with the doors unlocked. The insured's attitude increases the likelihood that a loss will occur involving the house. Now let's discuss the important topic of risk management. There are 5 methods of managing risk, and the first one is risk avoidance. Avoiding the hazard eliminates the risk. For example, to avoid the risk of an automobile accident or house fire, a person simply does not purchase a car or house. The next risk management method is the transfer of risk. This is the most common and most popular method of handling risk. A person can transfer their risk to an insurance company, in exchange for paying a regular premium to the company. Sharing the risk is our next risk management method. Even when a risk is transferred to an insurer, it is common to share some of the risk. For example, the deductibles and premiums an insured pays for insurance are a form of risk sharing. The insured accepts responsibility for a small portion of the risk, while transferring the larger portion of the risk to the insurer. Next is the assumption of risk, also known as risk retention, or self-insurance. An individual decides to create a risk by doing something such as purchase a car or a home, and retain the uncertainty of loss. This means that the individual would replace the car or house, at their own expense, if a loss occurred. The fifth and final method of risk management is known as risk reduction or risk control. Risks can be reduced by employing loss prevention methods such as installing a sprinkler system in a building, no longer smoking cigarettes, or losing weight. Usually, employing risk reduction methods will lower the insurance premium for an insured. Underwriting is extremely important to insurance companies. Underwriting is the process of selecting certain types of risks that have historically produced a profit, and rejecting those risks that do not fit the underwriting criteria of the insurer. Good underwriting practices normally produce a favorable loss ratio. This means the premium collected, minus the claims paid and operating expenses, produces a profit for the insurer. Insurers must carefully underwrite all risks to avoid being the victim of adverse selection. Adverse selection is the tendency of insureds with a greater than average chance of loss to purchase insurance. With adverse selection, the insurer is confronted with the possibility of loss due to risk factors that were not factored in at the time the policy was sold. Insurers can avoid adverse selection by pooling the risks from more than one source, thereby spreading the risk. This can be achieved by insuring, during the same underwriting period, either a very large number of similar risks, multiple insured locations, or activities with dissimilar risks. In addition, insurance companies will sometimes use reinsurance as a means of reducing their loss exposure on a particular risk. Reinsurance is insurance purchased by an insurance company from another insurance company, rather than an insurance company accepting the entire risk and possibly suffering a catastrophic loss. The risk is ceded to another company or companies or risk pools to spread the risk. Congratulations!